Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Post the collapse of Silicon Valley Bank and other US regional banks, US Congress has begun hearings examining what went wrong and develop regulations to strengthen capital and liquidity standards. The spotlight, the entire banking sector is under expanded to China as well as global creditors look to recover money from China's troubled developers. On the yield front, the volatility has persisted, the US two-year yield rising above 4%. Good morning, JK. I think things currently look a bit cloudy as new updates keep emerging. As of now, the narrative remains that the Fed will start cutting rates towards the end of this year. But do you think, given the current scenario, we have sort of passed over the speed bump of the banking turmoil, or is there more to come?
Good morning, Swaraj. I don't think there is a clear-cut answer for that. Yesterday, Bullard was again on the line. He was saying again that the Fed cannot abandon its inflation fight on fear of financial instability alone. So, we'll have to wait more economic data and see whether the economy is weakening and whether inflation is falling. We will have a lot of evidence to that in the next 2 days. We have German flash inflation, Eurozone inflation, and more importantly, the core PCE price inflation from US, which will be published on Friday, month on month being expected to drop from 0.6 to 0.4, while year on year is expected to remain unchanged at 4.7%. But there are reasons to believe that the inflation still remains high. Data shows used car prices increased again for fifth month in a row, and they are at historical levels. Despite being down about 2% on a year-on-year basis. Inflationary forces remain stubbornly high due to structural macro drivers. So the Fed just erased 5 months of QT in 2 weeks, and that should also add fuel to the inflation fire. Although the money flow this time is more to the troubled banking sector, and so it may not have the same effect as a QE, but still, I think the overall money supply increasing should not be dismissed as not having an impact on the inflation as well. Eurozone year on year core inflation is expected to moderate from 8.5 to 7.1, and ahead of that we'll have German preliminary inflation reading expected to slow on both month on month and year on year basis. Australian inflation today showed a slight moderation. So all in all, a lot of cues to take from the inflation and to see whether the central banks continue to raise rates. Now there is no, clear-cut expectation on what Fed will do in May, and in fact, chances of a hike in May is a little better than 50-50 proposition. And just to give you a perspective, it was almost certainty that they were going to pass some days back, and it's all over the place. Because just before March 8th, the implied curve was indicating 5.67% as the terminal rate. So it's really a very, very wild market, so to say, on the bonds. And the 1 year consumer inflation expectation again rose yesterday with 6.3% versus 6.2%. That was, revised for the previous month. This is as per the conference board indicator. I think while the markets do look quiet right now, it may have a lot to do with waiting for more news on the banking sector, as well as the quarter and year ending that keeps generally traders away from committing themselves for new trades. And possibly we always see that January and April they always throw up something new as a trend, so there will be some caution into taking up new positions. But just to update on the yields, both 2 year and 10 year were up yesterday, even as stocks and the risk sentiment were somewhat better. Although yes, stocks were mildly lower, that is down to profit taking. Interestingly, 2 year yield is above 4% for the last 2 days. So that's something that we should take note of. On the dollar, again, the range trading on the Japanese yen moving more, and possibly due to higher yields in Germany as well as in the US. Euro is firm, but not finding enough strength to go above 1.0850. Once again, the quarter ending and month end demand on the euro is keeping it somewhat a bit tone. And also we have the Indian year-end not just a quarter end, the financial year-end for India, but this is one of the most quietest year-end that I have seen for several years, and we generally see a lot of flows, movements in the USD INR spot, and then also the cash spot premiums ruling either very low or very high, and a lot of volatility is what normally we are used to, but that's been well contained. Actually, this is also, I can put it down to the fact that the flows have been very, very minimal as far as Indian rupee is concerned. We just having the importer and exporters modestly hedging on dips and on rallies, and the central banks constant presence on both sides. Like yesterday, they were seen buying below 82.20 and contained any weakness in the dollar that could have arisen due to the year-end related selling. So all in all, we have a very quiet period. As someone said, the quiet periods can be read in either way. It can be seen as risk sentiment improving, or it is just a quiet period also means that something is brewing, and it can be something some bad news is about to come. So as far as Indian markets, we are getting a break tomorrow because the markets will be closed, and then we have the last session of financial year on 31st March. So look forward to some quiet period of trading after which we move into the new financial year. Thank you.
Thank you, JK. And just to summarize, yesterday Bullard has mentioned that Fed cannot abandon the inflation fight due to the fears of financial instability. On the data front, we have got the upcoming Eurozone inflation data. And from the US, we have got the core PCE, which will be published on Friday. However, we have observed that used car prices have gone up again in the US. And there has also been an increase in the overall money supply due to the banking turmoil, with funds flowing to the banks by way of BTFP and primary credit. Currencies have more or less been stable during this week. For India, we have got our financial year end. Usually, it has been observed that premiums are very volatile, but this time, however, it has been contained. Let's see how that goes. And of course, we have got a banking holiday tomorrow. So things seem to be all over the place when it comes to market expectations. It's a choppy market as data is sharply changing the narratives. So keep managing your risk. That's it from us today. Thank you so much for listening.